We all want to know how well we are doing in whatever it is we do. In school, a report card helps us to see how well we did at the end of the term. At work, we get feedback when we perform a task. And at home, we get commended when we do well or corrected when we do something wrong. Companies also need to know how well they did at the end of the financial year. One of the ways a company can tell how well it did is by preparing a statement of financial position or a balance sheet. The statement shows the assets of the company, the liabilities, and the capital or equity. The assets are always equal to the addition of the liabilities and equity. This is because the money from the assets are gotten from the capitals and borrowing. There are two types of assets, non-current assets and current assets. Assets are resources owned by the company. If the company expects to use an asset for more than a year, it is a non-current asset. For example, the building owned by the company, where it has its offices, is a non-current asset, but the items the company sells is a current asset because the company expects to sell it within a year. The money the company owes others are called liability. Like an asset, a liability can also be non-current or current. A company can borrow from the bank or can buy an item and agree with the seller to pay later. The money the company borrows is usually used for the business to buy assets or materials to produce. A company also gets money from shareholders and from retaining part of its profit. These are called equity. At the end of every year, the company has to account for all its assets, liabilities, and equity to help people inside the company and outside the company to know how well the company is doing. See you in my next class, guys.